In this video, I want to give you a unique perspective on how to look at financial markets from a professional lens. You'll find this information to be game-changing, but it does require you to see things in a slightly different way than you may be used to. Let's run the numbers. Looking at the news headlines, stocks sink as bears take charge and dollar rallies. Financial markets are like huge jigsaw puzzles. They've got so many moving pieces. Looming government shutdown turns up the heat on stocks at a bad time. As the markets go red, you'll see an absolute tidal wave of negative headlines and sentiment entering the market. When the markets go green, you'll see the exact opposite headlines. This headline today: tech stocks that drove the market rally are now down 10%. Fading consumer confidence shows cracks in the US economic engine. A vitally important thing is to remember price is always moving in a wave. It's always going down then up, up then down. The Dow drops nearly 400 points. All S&P 500 sectors retreat. Bank deposits drop by $872 billion from a year earlier. And the Dow notches its worst day since March. There are two ways to look at financial markets. One is from a retail perspective, the other from a professional perspective. The CTKS Global family is dedicated to bringing you the professional perspective. You can see there's a lot of panic in those news headlines. One thing that retail does, because there's so much information, retail just focuses on a few charts. Professionals know that this is akin to financially crippling yourself. When you focus on just the trades or the charts that you're trading, it's like picking up just a single piece from a 1,000-piece jigsaw puzzle set. Looking at it, thinking that's the entire puzzle. It is not. There's a deeper context. That particular puzzle piece belongs somewhere in this puzzle. The jigsaw forms a true picture. But what is that picture? And how does retail see it? The first thing to understand is Rule 446. All markets and therefore charts are intercorrelated and interdependent. Coming back to the jigsaw puzzle analogy, when you pick up a jigsaw puzzle piece, that belongs in a picture. It's not the individual piece that's important, it's the picture that's important. Professionals look at the market completely differently. They understand the Tier 1 charts. They're the engine of financial markets globally. They also look to the Tier 2 and Tier 3 charts to stack probabilities. It's vitally important to look at the Tier 1 S&P 500 and the Nasdaq. That gives you a probabilistic outcome on where the world's markets are heading. The Tier 1 charts control the entire global stock market. When you look at the S&P 500 and the Nasdaq, they are the unequivocal leaders. Different countries have different strengths, it's true, but the S&P 500 and the Nasdaq determine the health of the global engine. For example, when the S&P 500 and the Nasdaq come down, everything is going to come down. And you can see that blue line behind. That's Bitcoin. You can see the influence of Tier 1 charts is extreme. Not every country will move in lockstep, but the basic direction is like a gravitational pull. As the S&P 500 moved down, UK's market moved down. Russia's did, Taiwan's did, Singapore's did, India, Switzerland, Canada, and France. Tracking sectors and groups is also important. You can see as the S&P 500 came down, the information technology sector came down, communications came down, energy came down, industrials, materials, consumer discretionary, healthcare, financials. Consumer staples also came down: real estate, utilities, insurance, solar, regional banks, semiconductors, and agriculture. You can see if you're not paying attention to the Tier 1 charts, you're already in trouble. The DXY is a major player inside the Tier 1 charts. The Euro inside Tier 2. The Foundation membership at ctksmethod.org, where you receive those 27 monthly videos on the Tier 1, Tier 2 and Tier 3 charts, as well as the TradingView Indicator and 3-dimensional risk management. The Foundation membership is closing. Prices go up from the start of next month. The Foundation membership is really special. It's not subject to price increase. If you get it and stay an active member, the price will never go up. But please hurry, this is a strictly limited time offer. Retail is not taught about how the DXY and FOREX impacts the stock market and crypto, and also commodities. In fact, most of the training out there just simply says pick up a piece, study it, and that's all you need. The truth couldn't be further from that. The truth is, you need to see the formed picture from all those particular pieces, individual pieces. There is typically, but not always, an inverted relationship between the DXY, the US dollar currency index strength, and the main market strength. Please note, this relationship changes over time. Be very wary of simplistic relationships between financial instruments. They're simplistic and they're wrong. The complication inside financial markets, the jigsaw puzzle, is always moving. Hey, but that's what makes it fun. You can see a variety of different FOREX pairs here. I'm going to show you a different chart to align them much better for you. Inside the masterclass, we talk about inversion a lot. When you look at FOREX pairs, they give an indication and a direction to the market. They're very powerful. Be aware that retail rules are just that. They are not professional rules. In sell-offs, people say that consumer staples is a good thing to get into. They often say that healthcare is important to get into as well because they're defensive sectors. You can see here and now it didn't do any good at all. This is exactly why professionals have flexible rules. Rules change as economics change. Another very important Tier 1 chart to keep your eyes on is Bitcoin. Bitcoin is a Tier 1 chart because it's an incredible risk-on, risk-off indicator. We can see that Bitcoin has been coming down. When we look at the top alts, no alt can escape Bitcoin's gravity. That's why we look at the alts. The alts give us an indication if risk is coming back into the market or it's leaving it. We also know that there's a close association between the Tier 1 charts, such as the Bitcoin price movement and the S&P and Nasdaq, and therefore right across global markets. Professionals understand that all markets are intercorrelated and interconnected. Forex and commodities are intercorrelated and interconnected with the stock market, crypto, and commodities. Everything relates to everything else. So if you just pick up one piece, no matter what market that's in, and you don't understand, it's a big jigsaw puzzle that you're looking at. What you need to understand is the overall picture, where that jigsaw puzzle actually fits into the picture. That is the key. The fastest and best way of understanding how to get to a professional level is to analyze the Tier 1, Tier 2, and Tier 3 charts. But this is not any form of simple analysis. This is structural analysis. Price is always moving in a wave. In retail land, everything is very simple. It's either going up or down. In professional land, it's completely different. Price is always moving in a wave. It's always going up in a downtrend and down in an uptrend, and we know that. For example, as the Nasdaq came down, it did come back up again, but then it went down. This is a downtrend, but the concept is you will have ups in a downtrend and downs in an uptrend. The picture of financial markets is actually built on structure. Looking across the Tier 1, Tier 2 and Tier 3 charts and understanding that price is always moving between structural support and structural resistance levels. Retail have recent support and recent resistance levels, and they RIP your money because it's recent indicative price. Because of the wavy nature of price, we know that we control the trader investment, but the market controls the return. and price is always moving in a wave. Also, it depends on what you're looking at. We're going to go through three-dimensional risk management on the Tier 1 charts today. That is, we need to plan out where potential down paths, neutral paths, and up paths are going. We're not trying to predict price by doing this. We're trying to predict direction. If the direction changes, we can't be caught off guard. We need to know it. If you have a fully down month or a fully up month, you will often find that the three-dimensional risk management plays out very well as a price predictor. But the normal case is the price is always rebounding between the three cases. Just keep that in mind. Many thanks to everybody who watched and commented on yesterday's episode. Sanjeev said, make sure that you look at all the tier 1s because they're important to look at. We're going to look at the DXY right now. Thank you, Sanjeev. When looking at three-dimensional risk management, we can see that the DXY has followed a positive path. This has put the major indices and stocks and crypto under pressure as well as commodities. Dollar yen and the DXY tend to move in lockstep, and we've seen that this month. The euro dollar has an inverted relationship between the DXY and the JPY dollar yen pair. This can help us to understand where the main markets are going, where the S&P 500 and the Nasdaq are going, and you can see that's vitally important because if we don't know how markets globally are going. Currently, the euro dollar has gone negative. It's had a slight improvement. Another Tier 1 chart is the 10-year yield. A big thank you to Arjun. His comment yesterday, the monthly service is by far the most valuable subscription of all time. Thank you, my friend. These paths are inside the service and will help you to understand how structural support and resistance levels actually work. We can see that the US 10-year yield has been following a positive path, just slightly weakening. Inflation has been a central theme of this month, and we saw that US oil was going on a positive path until it left it. It's been going slightly away from the positive path towards the consolidation. That is actually really good because increasing oil prices are inflationary and will fuel further increases in yields, which will push the DXY and the Japanese yen up and the euro down, and also the major indices, Bitcoin and gold down. It does take time to see the picture, but when you lose focus on the individual pieces and start to see how the jigsaw fits together, it's magnificent. One thing to avoid at all costs, do not focus on a few charts. It's a guaranteed recipe to lose money. If you focus on recent indicative price, that's also a guaranteed method of losing money. You need to focus on structure and also the market pulse, having your three-dimensional risk management in play, because when you zoom out, it's easier to see the interrelationships. And of course, it's hard to get caught off guard if you're expecting things in a three-dimensional manner. When looking at gold, we know that the S&P 500 and the Nasdaq came down and then they slightly recovered. Now they're under negative price momentum. We're seeing the same kind of thing inside gold. The key to note, gold is largely consolidating at the current time. It's a slight bit negative, but it's largely on a consolidation case, and the month is not over yet. Bitcoin has been remarkably resilient, but it's still following a consolidation case at the current time. And you know that Bitcoin is moving in alignment, directional correlation with the main markets. We can see that silver for the first part of the month was tracking a negative case. It's since improved just slightly. The purpose of three-dimensional risk management is like this. If you were in copper and you saw copper coming down, it just applies to any chart. And then copper starts to improve in price and doesn't continue to follow the negative path. That is incredibly valuable information. The VIX measures fear inside the market, and it's a tier 1 chart. We can see that the VIX has followed a positive progression, and it followed a bit of a consolidation path, but then it took off. The key is that VIX did not follow a negative path this month. What does that mean? As there's more fear inside the markets, there's more likelihood of a broad-based sell-off, and that's exactly what we've seen. Junk bonds can also be an incredible predictor of risk-on or risk-off behavior. When junk bonds is coming down, that means risk-off. That also means prices are coming down. We can see that quite easily. When we look at the S&P 500, it's following a negative path, as is the Nasdaq, but the Nasdaq is a little bit more powerful than the S&P 500. Note that these particular three-dimensional risk management paths are formed with an understanding and a knowledge of structure. That is, structural resistance and structural support. These are not random lines drawn on a chart. I would like to thank Crypto Badger for his very kind comment. The monthly CTKS method service is extremely valuable. It saves me an enormous amount of time, and the accuracy of the levels is mind-blowing. I highly recommend it. Thank you, my friend. Three-dimensional risk management is formed on an understanding of the structural levels. If we're coming into structural support, we expect a bounce, but if we're below structural resistance, we expect a sell-off. You can see in Tesla's price chart, Tesla has been bumping up and down all three cases this month. Started negative, went positive, and now is consolidating. Retail only assumes one position over a specific period of time is possible. It's not the case. Price is always moving in a wave between structural levels. In yesterday's video, Crypto Turtle said if you're not a service member, please consider it like a tool, like your phone, your computer, or your professional equipment that you need for work. $39 per month, as Edwin said, is $1.30 per day for 27 charts. I made the feedback in one trade. The videos inside the service are masterclass levels. I don't think any other service gives that much value. Crypto Turtle is saying a really important thing here, as the DXY is spiking up because we know it's taking that positive path, like the Japanese yen, inverted euro dollar as well. This is the time to buy and not to run. Because we believe in Borsog, buy on red, sell on green, but with masterclass knowledge. When looking at Microsoft did a very good job of following the positive price path until the market changed. Markets are always changing. Now it's been selling down, it's passed through consolidation and it's heading towards the negative case. To know if structural support or resistance is around this level and how strong it is, you just turn on the TradingView indicator that is provided with the service. That will give you the structural levels. After an incredible month last month, Nvidia has been taking the negative case, but that's pretty much the case with many things inside the market, but we've seen that strength go out of Nvidia at the current time. Structural support and resistance plays out on all of the charts, and when we look at crypto, looking at Litecoin was going negative like many of the charts that we've seen. It went to a consolidation case, looked at like it was going positive, and then back to consolidation. We can see that Bitcoin Cash is much stronger. It didn't follow the negative path at all. It followed the consolidation path, went to the positive path, and is pretty much staying up there. Bitcoin Cash is an incredibly powerful project. Total crypto market cap has largely followed a consolidation case this month. Ethereum has been under pressure. We've seen structural weakness in Ethereum, but it managed to recover. It's just marginally below the consolidation case. XRP has been doing quite well. It almost went negative and now is consolidating. Doge has been exhibiting weakness. It left the negative case, but it's not doing too well. It's currently just marginally under the consolidation case. Binance Coin, for all the negative press, is largely just following a consolidation case at present. ADA is also following a consolidation case, as is Solana. And one of the things to take note of, at the start of the month, Solana went pretty much nuts. It looked like it's going to follow a positive case, but then it came down to consolidation. Knowing that it's not continuing to follow the positive case is very, very valuable information. Knowing these three paths helps you to not FOMO, and which is fear of missing out. You don't base any decisions on fear, you base it on knowledge. And it's important not to guess. When we look at what Solana did next, there was inherent weakness inside the market, and Solana felt it. But it's also an incredible project that recovers very, very quickly. When people first start off, they think that every single chart is independent from each other. This is not the case, and it has never been the case. But retail educators will say to you, this is the case. It is not. The key is to put the jigsaw pieces together and form a picture. And the problem is that that picture keeps on changing. But that's financial markets. You can make an unlimited amount of money, but you need to know what you're doing. One thing that we've seen, Bitcoin has largely followed a consolidation case this month. There's tremendous incoming good news for crypto. There is no doubt that Bitcoin will go up over the long term, but price is always moving in a wave. And Bitcoin's price, as you've seen, is tied to the fate of the stock market. A lot of people don't want to think that crypto and the stock market is tied together, but you can see this blue line, which is Bitcoin. It is tied to the stock market, unequivocally. One thing that you must keep your eye on is the DXY. Further DXY strength means further weakness is inside crypto, commodities, stocks, and indices. A very big thank you to Edwin, who left the comment. Visit the CTKS method website to lock in the old price. It's just $1.30 per day for 27 charts, 27 videos, 27 video explanations of three-dimensional risk management and structure. What a bargain! Thank you, Edwin. Let's talk a little bit more about structural support and resistance levels. Let's pop on the DXY indicator. There's a very big difference between retail levels and professional levels. Retail think that there's only one support or two or three. Resistance levels and support levels. This is not the case at all. What you look at when you're a professional is support and resistance levels that play out like an EEG. What do we see here? The DXY was having trouble coming up and through this smart money resistance level around that 105.6 mark. It just got continuously rejected, but when it got above it, it moved with authority up through the next structural resistance line, which became a support line and was rejected up here. You can imagine if you were trying to look at the DXY like this without the helpful guide of where structure exists, it would just be guessing. And the DXY is marked up with the CTKS method, which is a standards-based process to reveal smart money buy and sell levels, and it's marked up for all of price history from 1967. This is not recent indicative price. This is all of price. When we look at what could happen, we saw that we had a fresh air gap just up here and price moved up very, very quickly. We could see something similar if we don't consolidate around these levels, something to be very aware of at the current time. There's a huge difference between professional levels and retail levels, and a huge difference between professional thinking and retail thinking. Retail thinking is just picking up one chart and analyzing it. Professional thinking is looking for the picture, and understanding this picture is created by structure. Professional thinking involves understanding the Tier 1 charts, not just in terms of only the three-dimensional risk management, but the structure, where smart money is buying and selling. Then we use the Tier 2 and Tier 3 charts to stack probabilities. We're looking for market turns. We're looking for the markets to bottom out at this current time. When they do, we expect double-digit % gains across crypto. Please let me know in the comments, when do you think the double percent gains are coming? I can assure you they are coming. If you analyze the Tier 1, Tier 2 and Tier 3 charts, you will see things starting to turn around. On your journey away from retail into professional, you can see how important it is to do the market pulse, to understand where structure is, and to do your three-dimensional risk management and apply your flexible rules. It takes time to become a professional, especially in financial markets. There's a lot to know. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.